Good morning and welcome. My name is Derek Gilbert. I represent the wealth management side here at Anthem Strategists. We're so glad and excited you're here. We are here today talking about the Silver Tsunami. And to be really honest, I hadn't heard that official term until we started prepping for this a few weeks ago. But what the Silver Tsunami is there are thousands and thousands of businesses across the country right now that are waking up and realizing they don't have a plan. They're actually realizing they are far closer to the Medicare age than the startup age on things. And so what we found here at Anthem, working with clients, helping hundreds of people retire and sell their businesses, is if you have a proactive plan, it leads to more efficiencies, more value for the practice, paying less in taxes, and more control in that process. So we're thrilled that you're here today. We're going to talk a lot more about that. So the flow of the day, we're going to have several speakers. We're going to start off with Brian Kaiser, our partial CFO today. He's going to speak about building a business buyers actually want. We're going to have Ben Wilson talk a little bit more of the tax side of selling the business. We're going to have Tom from Equity Advantage share a little bit more about the 1031 concept and some different efficiencies there. And I get to wrap things up talking about life after the exit. But before we really dive in, do me a favor. I know I do this at risk of knowing it's 8:30 in the morning. I haven't had enough coffee yet. Do me a favor, close your eyes for just half a second. So I want you to envision yourself that you're on the Oregon coast, little tiny state park, and you roll around the corner and you see a spot, and this spot sticks out just a little bit further.
Worth. Wrong question. The best question they should be asking is, do I have a business that someone would want to buy? And that oftentimes the question is no, you don't. Because they look at revenue. My revenue is growing. I'm doing great. My revenue is $10 million a year. Well, how much of that are you keeping? And just because your revenue is growing doesn't necessarily mean you have a business that someone wants to buy. A business half your size could be generating a lot more interest from a buyer than yours is. And we're going to talk about those things because revenue isn't the driver. It's not the indicator. What buyers are looking for, I would say the same thing that bankers are looking for, investors are looking for. They're looking for profitability, they're looking for predictability, they're looking for visibility, and they're looking at risk. So all those are four concepts we're going to kind of keep touching on in the next 10 minutes, but we want to keep those in mind. Because if we keep those in mind, we start looking at what these a buyer is going to want. We can start working on those today to start improving the value of your business immediately and then be prepared for a sale 2, 5, 10 years down the road. An important point, I'm going to talk about 6 points as we talk about what a buyer wants to see as far as a valuable business. Number one, we already touched on it, revenues don't create value, profitability does. So just because your revenue is growing doesn't mean a buyer is going to be attracted to it. They want to see profitability because a buyer is not purchasing your past sales, they're purchasing your future profitability. And so they want to know, is this business going to create the value and the lifestyle for me down the road if I buy it? And if they don't see that, they're going to say, nope, I'm going to pass on this one. The second thing is they want to see clean financials. And this is something I talk about every time I do a seminar, is bad information equals bad decisions. If you have bad information, you only make a good decision by accident. Because if you make a decision based upon the information you have, it's going to be bad because garbage in, garbage out. So I encourage business owners today, start making sure your financials are clean. And I say shamelessly as a plug, this is where your CFO needs to help you. They need to help you start beginning today to clean up your financial statements. If you as a business owner can tell me what your revenues are, great. If you can tell me how much cash you have in the bank, great. But if that's all you can tell me, you've got a problem. You as a business owner should know your numbers. You should know your financials. What's your profitability? Which product lines are making you the most money? Which division of your business is profitable? Which ones aren't? I know people in construction, they can't tell me which jobs make any profits. And these are the kind of things you as a business owner, be prepared to know. And you need to start working on that today. So not only are your financials clean, are your books tidy and buttoned up, but do you know your numbers? Because as I talked about a little bit ago, predictability equals value. Visibility equals value. And business owners want to see you managing your numbers, managing your business, because if they don't see that, they see risk. And they don't like risk. Risk decreases value. Visibility and certainty increases value. Point number 3, more about visibility and predictability. When we talk about forecasting and looking into the future, no forecast is perfect. They're not meant to be. But what they do is they tell a buyer, you are actively managing your business. You are trying to figure out what the future looks like. You are looking down the road. You're forecasting. You're putting budgets in place. You got KPIs. These are the kind of things that a buyer likes to see because they know that you are actively managing your company. And you're not just you're proactively managing rather than just reacting to whatever comes along. Because these are the things that gives you visibility, gives you a more successful business as you're preparing to sell. And the more successful your business is, the more valuable it's going to be to a buyer. And you think about it, if someone's going to write you a big check to acquire your business, they're going to be asking questions like, well, what's going to happen next year? What happens if my sales go down a year from now? What happens when the seller, the owner of the company, goes away? These are important questions that you have to be prepared to answer. And that really leads into the next one. Cash flow tells the real story. Cash is still king, always has been, it still is. Profitability is great, but profitability doesn't pay your payroll this Friday. It doesn't make your bank loan. It doesn't pay vendors. Cash do. So those are the things that a buyer wants to see is your business generating cash. Yes, it needs to be profitable, but more importantly, is it generating cash? Because they're buying your future cash flows, not your past sales. It's not uncommon for growing businesses to have cash flow challenges because as you're growing, you're having to buy inventory, you're having to pay wages. You need that working capital because oftentimes you have to expend money before you collect money from your customers. I'm working with a construction client. They are oftentimes, they have a lot of government jobs. They could be 90, 120 days out before they collect any payments. And that time they've had to buy supplies, had to pay subcontractors, pay their employees. They need 90 days worth of working capital just to make do. So as you're planning your cash, that is telling any future buyer that this business is being well run. And a buyer wants to see that. That makes it more attractive to them. They see less risk. They see more visibility into the future because this is being actively managed. The fifth thing I touched on is about owner dependence. Owner dependence is a valuation killer. If you walk away from the business as the owner and it stops tomorrow, then your business has no value. If it's dependent upon you, it has no value. As you've built a successful business, you've been the chief salesperson, you've been the ops manager, the sales manager, the production manager, you've been chief cook and bottle washer, you've done everything in the company. And if that's still the case, your business has very little value. If every decision in the company has to cross your desk, your business has very little value because any buyer knows that as soon as they buy the business and you leave, the business will not operate without you. So, as you're preparing to sell the next 6 months, the next 2 years, the next 5 years, begin putting people, processes, and systems in place to replace you so that your business can operate a day, a week, a month, a year without you being present. If that's the case, you have a very attractive business to a buyer. And point number 6, start earlier than you think. You always hear that. What's the best time to start planning for a sale? That was 5 years ago. What's the second best time? Today. Start today, preparing for that sale. Because the market rewards the business owner who prepares. If you prepare 5 years, 10 years for the eventual exit, you're going to be much better rewarded for that effort. And you still have time. You may be old like me, but you still have time. You may be young. You may be only 60 and thinking about selling. You still have time. So start today. Get to work. And a lot of that has to do with putting those profits and people in place. Because things like putting systems in place take time. Improving profitability takes time. Cleaning up your financials takes time. Growing revenue and improving cash flow takes time. So all those things take time. So begin today. Get to work, hire the right people, get your CFO active because a lot of these things are going to take their help to accomplish, and get to work today. And here's an important concept. It just struck me when I was thinking about it. The owner who receives the best outcome from a sales transaction usually doesn't prepare for the exit strategy. They prepare their business to operate successfully without them, and a successful sale is a byproduct of all that preparation. So, remember, buyers are not buying your past. They are buying your future. But if they're buying your future, that means that they can make your future much better for you. So begin today to drive value by cleaning up your numbers, improving your profitability, improving your cash flow, making you as the owner expendable, and getting better visibility into the future and your numbers of your business. So with that, I'm going to turn it over to the tax guy, Ben Wilson, talking about the tax consequences and the tax benefits of a sale.
Thank you, Brian. Well, I appreciate you guys all spending a morning, and Derek did it very well. You know, coming talking taxes in the morning is a dangerous proposition. The good news is, like, if any of us close our eyes, I'll just imagine that you're probably imagining Derek's example of his trip. Not that I'm boring any of us to sleep, so that gives us an out. I do want to kind of talk through two main areas that we're going to be looking at. And this isn't covering all of a sale, but just kind of give you some ideas of some of the complexities, some of the options that are out there when we're dealing with a sale. And focusing on the two main areas here, we have the timing and tax bracket. And we'll hit into each one of these a little bit. Both of these work together and are integrated, and we'll walk through some examples to kind of give you a flavor of what we can do. Our current tax framework, some of you may not realize this, if you paid a tax, just got your taxes done, or that we're in a historically low tax environment. So some of that may not feel that way when you're filing taxes or paying them, but that's where we're at right now. Top federal bracket is 37%. We got capital gains brackets of, there is a 0% bracket. Some of us may know of that, some of us may not. And then it goes up to 15, 20%, and there's actually a 23.8 for some of us. So we live in a graduated system, which basically means the more you make, the more they want. And so the pieces of that, a lot of our strategies are related to being efficient in that tax bracket. Some of the things I want to talk about today is an installment sale. If you've never heard of an installment sale, the basic theory of that is that you're allowed to sell your business in this scenario and take payments over a period of time and only pay taxes as you receive those payments. So some of our accountant folks here will cringe a little bit in some of this math, but I'm trying to make it so that I can do it in my head, which it has to be pretty round numbers. So pretend that we had a $100,000 sale that we were going to receive over 5 years. And so what would happen in that, as we receive those $20,000 payments, we'd only recognize those as we receive those. So in year one, we'd recognize 20,000, year 2, 3, 4, and 5, instead of recognizing the full 100 grand in the year of sale. And so that ability to use the installment sale treatment really gives us some ability to spread that out, keep those tax brackets lower. So some of the key advantages on that is you get a little bit of a second dig at the sale too, because you also earn interest on the contract. So not only are you receiving the sales price, but the note that you're carrying over the term of the contract, you receive interest. And so that gives a little bit more income that you can gain. And like we talked about, the ability to spread across multiple years is the main advantage. The disadvantage is that you become the bank. And so if something happens on that contract, if they didn't prepare, like Brian talked about, the business, and that suffers, and your collateral's the business, you may get something back that you don't want. And so being the bank has some risks when you're carrying that note. And then also, you may not be able to buy that matching truck and trailer because the proceeds aren't immediately available. They're spread out over the term of the contract. So the other main disadvantage is access to the sales price. Some of the key considerations that we look at is the collateral. If you don't want it back, it's not very good collateral. And so looking and seeing what you can do to kind of shore up that piece of things. We also have to delve into it, and some of our accountant friends in here would want you to know what the term hot assets means. And yes, some of these things in our accounting world aren't very exciting, but who can't get excited about hot assets? And so those are accounts receivable and some of those type of things that aren't eligible for installment sale treatment. So when we're walking through a sale, we have to be very cognizant of some of those rules. And then the other main consideration is just where we're going to be at in the future. Some of our recent tax rules are made permanent, but we always kind of smile at that because they're permanent until they change again. And so being in a historically low tax environment, spreading income into future years carries some risk. And so we want to look at that as well. One of the things that, depending on where we're at in this installment cycle, we can alleviate some of those risks and get our cash to our clients on the sale quicker. So we have an example of a year plus 2 days to spread it over 3 years. That's being a little aggressive, but pretend that we're coming up towards the end of this year and we're wanting to sell our business. We could receive that first payment in December of this year, second payment in January of the next year, and then the third payment of January the following year, and spread that income across 3 different years and get our money in a fairly quick manner where, depending on how you structure it, you could get, under my very simple example, 2/3 of it in a couple days of the sale. And yes, now your only remaining risk is the third that's out there. And so the ability to get that pretty soon is a common structure for some of these if there's risk in collateral or other things, but we still want the tax advantages on that side. Couple other just kind of notes, and these are not all inclusive, these are just some of the common things that we've seen when we're working through some of our clients, is converting some of the sales price to different things, whether that be a long-term rental agreement, whether that be an employment contract, or some of these things is another way to leverage the spread on some of these things. So what that would look like is you would convert, let's say you're going to have a 1.2 million sales price. You could have $1 million be the sale of the business, spread that out over the installment contract, and the other 200 grand could be split up between either rents or employment contracts that you do. So you're working with the buyer and the seller to come to a mutual understanding on that. Some of the advantage of that is one of the things that we don't always think about when we're selling the business is health insurance costs, and some of those related things are some of some of the things that we forget is one of the biggest expenses that you would have that isn't covered by the business anymore. So that gives us the ability to keep the health insurance because we still are an employee of the business, and you can extend some of those benefits. You can also fund the retirement plan if you're still on the payroll, so you have some ability to keep some of that income away from us as well. Some of the downsides on that is you're potentially converting, and this is what we'll talk about next, is converting some of that potentially capital gain income into ordinary, because rents and payroll is ordinary income. Oops. Kind of talking through the tax bracket efficiency is really kind of getting an understanding of how we pay taxes. And so if you're going to only remember one thing that I'm going to say today, it hopefully is this next piece. And so is that besides the sales price, the allocation of what you sell is the single most next important thing. And so the reason for that, so I'll say that one more time. Besides the sales price, which we all agree is very important, is the allocation of the assets. So of the sales price. So in our previous example, the allocation was $1 million to the assets of the business and $200 to long-term contracts. That's pretty good. But if that $1 million of sale of the business is equipment, we have a significantly different tax rate than what it would be if it was to goodwill or something that is what the IRS calls an intangible. Ordinary income things are things like equipment, receivables, inventory, things that get capital gains are goodwill, client lists, buildings. We'll talk about, Tom's got some great stuff for us on buildings here in a second. But the main, if we look at the math on that, you're looking at $1 million sales price in my made up example again. Our top bracket, we remember, is 37%. On the taxes on that would be 370 grand. In a capital gain scenario, we would be looking at the same $1 million at 20% as 200 grand. So $170,000 difference in just the tax bill. So a significantly different amount of money left over from the sale of an asset, depending on how it was allocated. So that is the single most important thing, and hopefully if you don't remember anything else, you'll take that away from our talk today. One of the other things that we like to do is look at our brackets and say, hey, do we have family members that we want to shift some of this income to? Had an example of one of our clients has 3 kids. They're pretty responsible kids. That's a key to some of this as well. Is they were able to move 15% of their building to them using some gifting strategies and moving that to them. And then as the building sold, those gains went to each of the kids and the parents. And so they were able to spread that income across a number of different returns to save a significant amount of tax bills. The kids didn't like their tax bills, but dad paid for them anyway, so it wasn't too bad. Some of the advantages of that is not only in the sale, but all running up to it. So they did that 3 or 4 years before the sale. So the kids were using their brackets and that income was being shifted to them on an annual basis. And there was some significant savings between mom and dad's top bracket and the kids' lower brackets as they were going. So not only in the sale, but as we went. There was some risk, and we'll talk about here in a second, but we did recently arrive as the worst state to die in. So not because the weather's crummy, but mostly because of our estate tax rules and the different income taxes that we have as well. So we were able to utilize some of that for estate tax plan as well. Disadvantages, we were talking about back in the back earlier about different family dynamics and things like that that can create some strain on family relations depending on how some of these go. So we have to be cognizant of those things. I wanted to run through one more example on that. Who's heard of a donor advised fund? Is that a familiar concept to some of us? Just in case it isn't, that DAF or donor advised fund is a charitable fund that you can own and control and get a charitable deduction for putting money into it. So the example we had here is we had a client that was potentially going to sell their business for $4 million. So they did 10%, but that's a little harder math. We'll do 25 to make it easy for us. They 3 to 6 months before, they went ahead and gifted 25% of their business to the donor advised fund. And so that allowed them to get a current income tax deduction for the value of that donation. So that was given $1 million tax deduction on their return as a charitable deduction. In addition to that, when they sold the whole business for $4 million, only $3 million of it was taxed because the other $1 million of the sales price was owned by the donor advised fund. And so we escaped tax on a whole, 25% of it, and then only had to pay on the $3 million. So the math on how that works, just using the charitable rates, is we got $1 million deduction, and that was worth $400,000 to us because they were at top bracket. We'll round up a little bit, $370,000. So that gave us that advantage of a deduction. The $3 million, if we allocated that all to capital gains, we pay $600,000 over there. So we're almost able to make ourselves whole on some of that by scrubbing away a lot of that tax deduction on that sale. And so the client who was charitably inclined was able to meet a lot of their charitable endeavors and also escape the tax on a significant amount of the tax bill. In our Arizona office, we have a guy that's certified as a certified exit planner. He came down sick today, so you're gonna have to miss some of this. I did want to share, I do have some experience in thinking about retirement and things like that. I was recently gifted, well, it's been a little while. You may not be able to see this if you're online, but this is a tiara that it says officially retired. So my friendly teammates here got this for me a few years back because I was in a meeting and I foolishly did not have my door shut, and someone asked me when I was going to retire, and so they thought that they should in advance get me something so I'm prepared. And I think it's one of those things it's funny, but it's also a reminder that we'll all be there someday. So that's a piece of things that we have to consider. And in his training, he walked through the 5 Ds of things that we have to consider. And so this is for all of us to kind of talk through and consider. a lot of this isn't really all that much fun. So the first one is death, is really being cognizant of where we're at in the estate taxes and where we're at. We're one of 12 states that has an estate tax, and ours has the lowest limitation. So that's also a big piece of our exit planning, is where we're going to reside, and then eventually where we're going to pass. And so being cognizant of that. Thing that we also have to do, even if you're staging your business, we have to be aware of any disability. Lucky thing for us accountants, all we have to do is be able to kind of roll ourselves up to a desk, just avoid head injuries, and we're okay. In a lot of businesses, there's more physical demands and some of those things that you have to be aware of. Divorce. It's one of the D's here. It's also a good way to create financial strain, and so that's something we have to consider where the businesses are going to go on that. Disagreement. This can be between business owners or just on any side type of things, especially in some of the family dynamics and some of those things we have to watch out for. And distress. What if you don't want to do it anymore? Some of those type of things, and say, that's where hopefully we'll have some time in the Q&A section to talk about how to best make that sale of the business in a good time. And then we got acts of God and some of those things that we have to worry about, and who knows, tariffs might be an issue for some of us. And the last kind of point before I turn it over to Tom here in a second, is talking through. We're getting rid of one of the three legs of our stool. Anybody's ever tried to sit on a two-legged stool, that's not an easy thing. And so really being cognizant of the aspects of what's going to replace that third leg, whether it's a hobby, whether it's nonprofit work, whether it's something, and just being aware that some of that personal, financial, and business, that we're going to have to definitely transition on that side of things and take care of that. So some of that, I wish Samuel could be here to present some of that, because he's an amazing resource to talk through some of these things. But these are some of his thoughts that we wanted to share as well. So I get the advantage of turning it over to Tom now. You can keep this if you want.
So this is my,
Getting your slide up, Tom.
all right, well, thank you for having me here today. I really appreciate the planning aspect of all this, because when we get calls into our business, one of the main things that we are stressing to everybody is this going? We good now? All right. We're always stressing planning. We'll get a phone call comes in, and people may think that they don't have a lot of questions. They just don't know what questions to ask, and we'll often spend 15 minutes to an hour on the phone with somebody the first time they call in. Anyway, so my company's Equity Advantage Incorporated. We facilitate 1031 exchange transactions. We started out here in Salem in 1991, and so we've been doing them quite a while. My brother and I started up the business initially, and still at it. So we'll go through some of the basics of 1031 exchange transactions and take them there. I don't know how many people in here are familiar with exchanges or have done them personally. Okay, all right, so most everybody, yeah, good. All right, when we look at an exchange transaction, we always think there's basically four cornerstones, what we call them, when we're doing an exchange. First of all, it has to be an exchange. People can't just sell a piece of property and go out and buy another piece of property and call it an exchange transaction. You actually have to be exchanging with somebody for this to be a valid 1031 exchange. And when exchanges first started out, they've been around since 1921. When they first started out, if I had a piece of property that Derek wanted and Derek had a piece of property that I wanted, we could actually just swap properties and do a deed swap. We'd have an exchange agreement, and that would be a 1031 exchange. Not many people have that situation. We still come across those, but when we're doing an exchange or when we're involved with it, we are actually the party that people are exchanging with. Okay, so we've got an exchange agreement between the client and ourselves, Equity Advantage. So we receive property from them through this transaction, and then we go out and buy property for them as replacement property. I'll go through the steps and how that works. So it has to be an exchange transaction. Both properties have to be what's considered like kind. Now, like kind does not mean rental property for rental property or bare land for bare land. Like kind is very flexible. It just has to be any property that's either used in for productive use in a trade or business or for investment will qualify for any other type of property that's used in a trade or business or held for investment. So we can exchange bare land for commercial buildings. We can go commercial into multifamily. Almost any type of property that's out there that's not somebody's personal residence. And then we do have situations where those can be involved as well. But almost any other property can be considered like kind to any other piece of property and can therefore be exchanged. Napkin test. The napkin test is something that we will try to follow if you want to have a fully tax-deferred exchange. And what the napkin test says is that property you should go across in value, equity, and mortgage in order to have a fully tax-deferred exchange. Now, the mortgage part is not a necessity in this because it can be offset by adding cash. So the real important things when we're doing an exchange in order to have a fully tax-deferred exchange would be to go across in value and equity. So you spend all of the cash that comes out of a sale to acquire new property or properties. You can go into multiple properties if you want to. But all the equity needs to go across and buy something of equal value. And in doing so, if you had debt on the property, you're automatically going to incur new debt that's the same amount, or you're going to add cash to the transaction to offset that debt relief. Okay, so that's certainly fine. And then continuity of vesting, and this is a big deal when we're dealing with clients on exchange transactions. So we have to have the same taxpayer giving up and receiving property in a 1031 exchange. You can have a situation where somebody sells under their individual name and buys under like a single member LLC that's a disregarded tax entity. That's fine. Or buys under a revocable trust because we're not changing the taxpayer. But you do have to have the same taxpayer giving up and receiving properties. Okay, and it is a tax-deferred exchange. It's not a tax-free exchange. So you can continue to defer taxes over and over, and we tell people you swap till you drop. And if you do so, then those gains that have been previously deferred end up going away because people will get a new, the heirs will get a new stepped-up tax basis in the properties. Okay, so this is where we see an exchange transaction. As far as a client's concerned, it's not much different than an ordinary sale and purchase of property, with the exception that you do have some time frames involved here. So people will go out, you've got a piece of property, you'll go out and list the property for sale like you normally would, find a buyer for the property, open up escrow, and that's when we get involved in the transactions when the client has a buyer. Escrow's open. We'll certainly try to be involved with them through consultation, giving them answers to any questions they've got well ahead of time. But this is when we start preparing documentation for an exchange. So at that first close of escrow, what's happening, rather than the client being a seller on settlement statements and receiving proceeds from that sale transaction, property does transfer through us, through Equity Advantage, and then over to the buyer. But there is a direct deed. The IRS does allow direct deed transactions, so deed transfer goes straight from exchanger to buyer on that sale. But rather than the exchanger or seller of the property receiving those proceeds, they come to Equity Advantage. We now hold those funds so that they don't have what's considered actual or constructive receipt of those funds. Okay, so money comes to us. At that point in time, after the sale closes, we're going to have two time periods that fall into place. They are a 45-day identification period and a 180-day exchange period. So those will both start at the close of escrow. Within the first 45 days after a sale closes, the client has to identify properties to us. And they can identify a few different ways. I don't know if I have a slide that covers this, but the identification of these properties must be made one of three different ways. They can either identify up to 3 different properties with no restriction on values, or they can identify more than 3 properties as long as the total combined value of these properties does not exceed 200% of the value of the property they sold. Third identification rule is what's called the 95% rule. And it states that if the client has gone over those first 2, they've gone over the 3 property rule, and they've gone over that 200% rule, then the 95% rule says that that's fine as long as they end up acquiring 95% of the market value of everything that's been identified. So they really have to buy everything through the exchange if they go that route. We don't have a lot of people that go down and use the 95% rule. They have 180 days total to close escrow on all their acquisitions. When they're buying the replacement property, they'll go out and make offers on property the same way that they normally would. Again, they want to make sure that they're buying in the same name as they gave up property, the same tax-paying entity that they gave up property initially. They'll make an offer, open up escrow. They'll contact us, say we've got an escrow open for the sale transaction, or for the purchase transaction. And then we get in touch with escrow and we prepare documentation for that acquisition. At the close of escrow, escrow will just reach out to us. We wire transfer funds directly to the escrow company. Any additional money that needs to come in for the acquisition, whether it's cash or loan proceeds, will go straight to escrow. Nothing has to come through us. And again, the deed transfer will go straight from the seller of the acquisition property over to the exchanger. So we did cover this a little bit. Like-kind property, again, very flexible. And we have people, when they're getting into these different stages of life, we're talking about retirement here, when we go through the different stages of life, people's investment needs obviously change. They might be when they're younger, they need cash flow, or maybe they don't need cash flow because they've got a good job. And so they'll be picking up properties that are maybe appreciating in value more, or they might have properties that are more leveraged to get appreciation. And then as time goes by and they're looking towards retirement, they may be looking at properties that are going to be less management intensive and give them better cash flow. And so they'll move into something that does these things for them. They might be going from properties that are held by partners. And this is a very common situation. We've got people that will be selling properties that are owned in partnerships, and they're either tired of their partners, or they want to go out on their own. They have different visions about where they want to go because they are getting older. And so it's really important that they do planning. And too many times people will contact us and say, I've got a piece of property that's selling, and it's owned in a partnership, and we want to go our own separate ways. My partner doesn't want to do an exchange. They just want to take the cash. I want to do an exchange and go my own separate way into something that's maybe going to be a retirement home for me down the road. So these are situations that arise all the time. Now, I'll touch base on that real quickly. This partnership situations, because we have to have this continuity of vesting, we cannot do an exchange for partnership interests. So if we have a partnership like a multi-member LLC and the clients want to go their own separate ways, we have to do what's called a drop and swap transaction, where the partnership ends up getting dissolved, properties deeded from in this case, the LLC, out to the individual owners as tenants in common, so that they now own a real estate interest rather than having partnership shares. So we've gone into something we've gone from something that was not exchangeable, the partnership shares, into something that is now exchangeable, being in the way of real estate interests. So when the sale now does close, we've got multiple sellers that are on title. We do an exchange for any of those partners that want to do an exchange. The others can just take their proceeds and pay taxes on them. Okay. Yeah, so a lot of flexibility in the way of what can be acquired. I'll talk real quickly about vacation properties as well. A lot of people will want to go into, as they get older, they want to buy a piece of property that they may ultimately retire in, or they just want to buy a property that they're going to treat as a vacation house. The IRS has a revenue procedure that allows, that people want to follow if they want to do an exchange on an acquisition or even a disposition of a second home or a vacation home. And that revenue procedure states that if we're going into a piece of property that's going to be a vacation home, then for the first 2 years of ownership, it's a requirement that they have at least 2 weeks worth of rental income on the property, and that they don't use it personally for more than 2 weeks out of the year, or 10% of the total time it's rented out. So if it's rented out a great deal of the year, maybe 200 days out of the year, then they could stay there for 20 days, okay? If they're selling a property that is a vacation home, then same thing applies, that for the 2 years preceding the sale, they want the property to have at least 2 weeks worth of rental income on it, and you're not supposed to be using it personally for any more than 2 weeks out of those 2 years preceding the sale, or 10% of the total time it's been rented out. Tax hit. Talked a little bit about tax hits. Yeah, it's a big deal. This is money that they're not going to get back too easily. So if we're selling a piece of property, and these climb very quickly on a sale of a piece of property, it's a very large sale transaction, but your appreciation taxed at ordinary income rates, really 20%. Depreciation recapture gets taxed up to 25%. You can see the Oregon rates here. So yeah, it's very, very common that people have tax hits that are in the mid-30s to 40% even. Again, planning, fail to plan, plan to fail. These are mistakes that we see people making, or just information that people don't have when they come to us a great deal of the time. Again, it's way too often that people are not talking to all of you about these transactions. I don't know how many people in here will end up with a client that comes to them and says, hey, by the way, I sold a piece of property last year, and what's that mean to me now? These are conversations that they should be having well in advance. So this is where we're always trying to press professionals at all different levels to get their clients to be asking these questions early on. Are they selling a piece of property that is held under a partnership, or how do they hold these things, and what's their goal in the future? Very common that people don't know what their basis is in a piece of property. Many people think that their basis is just what they bought the property for, okay? And sometimes they might have done an exchange in the past, in which case a basis from a previous property is carried over into a new property, but they still think the basis is what they bought it for. Sometimes they think the basis is their equity in the property, okay? We see this all the time, and it's people that have been investing for years. So it's really important, because their entire tax hit, as everybody knows, that in here, that their entire tax hit is going to be based on that basis. How much did they sell it for over their basis amount? Okay. So we really want people to be asking these questions. We did talk about the property held in a partnership, and again, this comes up all the time. It really does. And so the vesting of these properties is super important to know what they want to do in the future. And usually we'll get, and I will say on these drop and swap transactions, the ideal situation is that they do the drop out of the partnership maybe a year ahead of time. Put some time in place between the drop of the partnership, the dissolution of the partnership, and the sale taking place. Have some seasoning that it's held and under their individual names, under their individual tax IDs. If they want to maintain the LLC protections, then when they deed out of the partnership into their partnership names, they can certainly set up their own individual single-member LLCs to hold their TIC interests if they want to do it that way too. But we get these all the time. People will be selling, and it's kind of a last-minute situation. But if they can do this ahead of time, much better situation for them. Sometimes tax professionals are very uneasy about a dissolution immediately prior to a sale taking place. Sometimes they're not. The other avenue for these partnership situations is that we can do what's called, instead of a drop and swap, we do a swap and drop transaction. We don't do these as often because in most cases the partners are not interested in acquiring any other property together again. But in a swap and drop transaction, we can do the exchange under the initial partnership that is going to be dissolved. That partnership then goes out and maybe buys multiple properties. We had a very large transaction like this about a year ago where there were three partners involved in the transaction, and they all wanted different types of properties. So their main entity did the exchange. That entity then set up multiple LLCs that were all single-member LLCs with the main partnership as the owner, as the member. So all of these LLCs were disregarded entities of the main partnership. And the entities went out and, through the exchange, bought multiple properties. Some of them bought into Delaware statutory trusts. Some of them bought into land acquisitions, vacation houses. I think they ended up buying at least about a dozen different properties with the idea that, okay, a year and a half down the road, we're going to dissolve this partnership, and now this partner is going to get these LLCs, this partnership's going to get these LLCs, and they did basically gave out all the interest to different partners later on. Let's see. Misunderstanding like kind. Pretty common that is an initial thing when people contact us. They think that it does have to be, a property has to be, bare land for bare land, it has to be rental property for rental property. So that is a surprise to some people. And when they realize that they can get out of, maybe we'll have a person selling a business and there's an allocation for the real property portion of it, that's land and the building itself. They don't realize that they can take that and go into maybe a few different rental properties and a vacation home, and convert that down the road to a new primary residence or something like that. So they don't always understand that like kind is not tied to a specific type of property. And then missing the deadlines. The 45 days goes really quick in these transactions. And if we've got a client that calls up and they say, I've got a sale taking place and we're closing next week, that's not the first time we want to hear from these people, obviously. But if that's the case and they don't have any properties picked out yet, then we'll advise them if they can, if it's not going to shoot it's not going to make a failed sale out of this, we advise them to push off that closing for a week or two. Give themselves a little bit more time to go out and find properties that will qualify for their exchange transaction. So 45 days is, again, it goes really quickly. And planning again, plan to be around for those 45 days. We get a lot of people that will sell a piece of property and they'll let us know, hey, by the way, I'm going to be in Europe for the next 30 days. Not a good time to be gone. 180 days is not that often a problem because if they can identify properties, and in most cases there's not an issue closing it. It still does come up though. We'll have, maybe a dozen times a year where somebody is getting up, pushing that 180-day time frame there, and they just don't think they're going to be able to get it closed. And we've had quite a few transactions where for whatever reason, maybe buyers' funding is not coming through. And in order to get those deals done, sometimes we'll end up having the client get the thing closed on a short-term seller carryback. Have them carry note trust deed, get the property into their hands, and then when the financing does come through, then they can pay it off at that point in time. Okay, we did cover that. Again, 45 days, there's the 3 property rule, 3 properties, no restrictions on value. Any number of properties, as long as they don't exceed 200% of the relinquished property that's being sold, or the 95% rule, which states that you've got to buy 95% of all the properties that have been identified if you've gone over the 3 property rule and the 200% rule. Okay, so the terrible T's, and there's a lot more than what we've listed here, but tenants, toilets, taxes, there's a bunch of them, and people don't want to deal with these when they're getting to retirement ages. So this is a reason why people will exchange out of one type of property into some other type of property. We've got, is everybody here familiar with Delaware Statutory Trust, or DST? Yeah. When they first came out, it was a property type that we really saw primarily just people that were wanting to retire, or they've been, maybe they'd owned properties, apartment buildings for quite a while, and they just really, they didn't have the energy for that type of investment anymore, and they needed something that was just really passive income, mailbox money type of asset for them. And so it's changed a little bit. We've had, that was, the Delaware Statutory Trust went from something that was being identified and acquired primarily by people that were later on in their investment life, were just tired of these terrible T's. It's gone from a situation where people would identify these when they're at that point in their life, or they would identify them maybe as a backup, because one of the nice things about a Delaware Statutory Trust, when somebody's doing an exchange, is that they could exchange a piece of property. Maybe they sell a building that's $1 million building, and they go out and they find a replacement property that is an $800,000 building, and it's just exactly what they want, but it's not meeting their value requirement to defer all the taxes. They can certainly just have a partially tax-deferred exchange, which is not uncommon. They take the cash, or maybe if there was debt for that 200, they can just go down in value and pay tax on that. But if they don't want to pay any taxes at all, they could go into just a 200% share interest in a DST. And so that was pretty common in the past. It still is, where people will just pick up whatever portion they need in a DST to make up the value to get them to their 100% mark for their 1031 exchange. So they were backup identified properties, DSTs were, or they might have been for those people who were just tired of managing properties. We get a lot more people these days that just like the ability to diversify through a DST into multiple different asset classes and get something that's really a big commercial type of asset. So you could take and go out of your $1 million commercial building and maybe put $300,000 into some multifamily, put $300,000 into senior housing, and put the balance into self-storage or something like that, or healthcare. So you can really diversify into a lot of different types of properties and also into different areas. A lot of these DST acquisitions are purchased and they owned in states that are very favorable tax-wise. They're in either low or no income tax states. You can go into tenancy in common. Tenancy in common, if you own a property as a tenant in common owner, So your name's on the title, then you can exchange out of it that way. You can certainly go into tenant in common acquisitions as well. So same type of thing, if you want to go into a piece of property that is maybe, again, a no management type, you can go into a TIC interest, fractional ownership, that might be a value add property. A lot of people will do that as well. We don't see as many of those being offered as we used to, but it's still pretty common. Retirement residence. So if somebody goes into a piece of property, they pick up a piece of property through the exchange that they ultimately want to retire in, that's certainly fine, you can do that. But it cannot be your intention to treat that as your primary residence at the time of the exchange. So when you buy it, again, it has to be something that you're going to treat as an investment property, whether it's short-term rentals, long-term rentals, a second home, any of these will qualify. You just cannot have, it just cannot be your intention at the time that you buy it for it to be your primary residence. So if somebody wants to buy into a piece of property that they're going to convert, do it, hold it for a year, maybe, there is no holding period requirement. A year is often encouraged by people in the tax and legal fields, but there really is no requirement that it be a year. It just has to be their intention at the time of the acquisition for it to be an investment property for them. Okay, that being said, we'll always tell people that a year has been proposed a couple of times, never passed, but if somebody buys into a piece of property, let's say somebody starts an exchange today, and they end up acquiring the replacement property in October. I'll tell people, if you're planning on moving into that property in the future, hang on to it for a year and a half as a rental property. You're going to get rental income for the 2026 tax year, all of 27, and maybe a couple months in 28. You got 3 different tax returns now that have some income and depreciation on that piece of property. It's going to be a pretty conservative transaction for them. And I mentioned swap until you drop. People exchange. Your basis is carried over from one property to another when you're doing an exchange transaction. You may have some transactions along the way where you did go down in value, or you took some cash out and had some tax exposure on that, but you can defer those taxes indefinitely. When you do pass away, your heirs get the properties at a new stepped-up tax basis, and then they can turn around and sell them if they wanted to with no tax exposure as far as capital gains is concerned. Yeah, so tax deferral is one of the most effective tools available to grow wealth. When people sell properties and they don't do an exchange transaction, they end up, a lot of times if they've got leverage on them, they might end up paying most of their cash that they've got out of a sale to the government in the way of taxes. And it's money, they worked hard for that money and for that equity, and it's really something that it takes a very long time to get this money back. So if they can push this forward, reinvest all their cash into new properties, again, whether they're leveraging or not, it certainly can help them build their wealth much quicker. And then we have, back in, we've been doing these exchanges since 1991. In the early 2000s, a lot of our investors started asking us about investing retirement dollars into real estate. You know, they're all real estate investors. They've done well over the years. That's what they know. That's what they like to invest in. And they've got all the retirement dollars in the stock market, and they just don't understand it, don't know it. So they want to take some of this cash and put it back into real estate, some of the retirement dollars. So we started looking at what role we might want to take in that in the early 2000s, I guess. And, you know, did we want to start up a trust company, or didn't really want to do that? Did we want to be third-party administrators? No. We decided that what we've been good at over the years is just facilitating transactions, getting people from where they are now into what they want to be in the future, and doing so by just setting them up setting up their, in this case, retirement accounts in order to do that. So when 2008 hit, we had a lot of free time on our hands because there were no real estate transactions taking place. So we started up a sister company called IRA Advantage. And with IRA Advantage, we set up people's IRAs or 401k rollovers, or sometimes we'll do solo 401ks for people. But most of the people that we get calls from are still, that they want to go into real estate or some sort of real estate related assets. They want to buy properties, they want to make loans even to builders. That's pretty common. Or maybe they just want to take and buy gold and silver. So we take them from where they are now and get their retirement accounts set up in such a way that they can make investments into things that they know better and really see a good future in. So we've got IRA Advantage. We have people also call us up and say, I've got a piece of property that would be great for your clients. We get these from brokers all the time. Well, we can't market these to anybody, but we do have a site that people can just, brokers, principals, anybody can go on and just list haves and wants on this site. It doesn't cost them anything. And so when people call us up now and they say, I've got property that'd be great for your client, we can tell them, well, we can't market it, but if you want, you can put it on this website. It's just another avenue for you. And so IRA Advantage, our Post 1031 site, and Equity Advantage, and we're just trying to help people get to where they want to be. Okay, I think that's all I got for now. No.
Thanks, Tom.
And I liked your vision.
Oh, thank you. Well, I appreciate you saying that because I'm kind of a Quentin Tarantino fan, so I normally start at the end, come back to the middle, and go back to the end. Because why I share that story is a lot of times when I work with small business owners, they just don't have that vision. And it sounds really, really simple, but how do we know what to do now if we don't know where we're going, right? So, one word I use in my practice, because, well, let me back up a sec. I've been doing this for about 15 years. I celebrated 15 years 2 weeks ago, and my business card says financial advisor. But I came to the realization pretty early on in my career that that's like the fifth thing on the list of what I actually do. I'm a psychologist, I'm a counselor, on occasion I'm a bartender, but trying to encourage folks to get that vision is more challenging than you think. We are not inherently selfish people. But for this conversation, for 2 seconds, I can encourage you guys enough to be selfish. Just for a second. I tell people, get it down to just you and your partner, or just you. And okay, if we do things right, where do we want to go? Because then we can back into all the other things. We talked about a lot of structural, mechanical things today, which are critical, but coming down to the valuation of your business, what's enough? Well, that really depends. I'm blessed in my business with perspective. I had 2 folks that hired me right when I started 15 years ago. One was a guy named John. John told me right from the get-go, Derek, I want to spend $15,000 a month for the rest of my life, make it happen. And you would never know it. He's a humble dude. He drives a nice car, but it's nothing flashy. He lives at Illahee, but it's a relatively modest house. That guy has cooked through now $20,000 a month like clockwork. No clue where it goes. Now he's got the resources to support that. Now on the other hand, though, is Leslie. And I retired Leslie out of the state. I think we're on 12 or 13 years. Leslie worked for the state for 43 years and never made more than about $35,000 a year. She lives comfortably on about $750 a month. But she's happy. She drinks tea, she reads books, she's never married, she has no kids. Leslie is a happy camper. So as I encourage you guys to be selfish, intentional word there, cast that vision. Because we're in a society where we're so pressured by comparisons and all these other things. Who cares? Me, I'm very happy with our vision of being on the coast for 10 days on retirement. I'm very happy with having hopefully some grandkids to chase around and a dog and gardening, all that stuff. Some people, though, they want to be on either end of that spectrum, and that's okay. Now, as it comes back to selling businesses and eventually having that freedom, you know, you've heard the theme today, right? Have a plan. The perfect time, 5 years ago, the next day is today. Like start getting those things in place. I helped a vet retire, and I've been telling him for years, like one of these days you're gonna wake up and you're not gonna wanna work anymore. And he hit that day, but we hadn't done anything yet. So all of a sudden, then we're 2 years out. So getting these things in place, whether you're 30 or young at 60 or whatever that may be, starting to cast that vision. One of my favorite things I heard is a client told me a few years ago, my plan is to work until noon one day, close up shop early so I can be on time to my own funeral. I didn't think that was necessarily the most effective plan. So start with the vision, and then we can back up, because with the business owners, you are your business. The business is you. You've got a passion. You're good at it. So trying to envision what things looks like on the other side can be really, really challenging. And it's hard to trust things that you are not inherently controlling. You know, with your businesses, you've got that control. You know what you're doing. And then all of a sudden you've got this big bucket of money that you still need to grow, right? But we're just nervous with trusting imperfect things like the stock markets or 1031ing a different property, don't fully understand. So finding those counselors and those people that you not only trust, but that you allow to speak into your life and make you occasionally uncomfortable is really, really healthy for you. Now, me, I think one of the reasons I'm good at my job is I view money highly unemotionally. To me, retirement's a math equation, right? Money in, money out. So there was where the rubber really meets the road is, do you want to live like John? Do you want to live like Leslie? Either way's fine. But casting that vision for yourself, then we can put some of these structural things in place to support that. So, you know, we talk about not only sudden liquidity events like selling a business or receiving an inheritance. The other thing I always have to talk on when I talk to my small business owners is what happens if, right? Like Ben touched briefly on disability. My father passed away about 6 years ago, but he was diagnosed with stage 4 non-Hodgkin's in 2012, had to stop working the next day. Now, fortunately, he and mom had built resources outside of what they did. You know, at one point they owned 13 residential doors in a big industrial complex in Corvallis. They both had other jobs, but fortunately put things in place ahead of that tough event that they never had to force sell something or not be able to take advantage of a 1031 exchange or things like that. So diversifying your resources, because frequently we hear that small business owners, hey, that's my retirement. And it is, that's a huge asset, right? But trying to diversify yourself outside of that asset, because the other thing I hear frequently is, I don't want to leave my employees or my family hanging. So how do we do that? So unfortunately, we're not gonna have time to get super into the details of what I do today. What I would highly advise you is find a team of counselors that you trust, CPAs, attorneys, advisors, and allow them to make you a little uncomfortable. Allow them to speak in your life and present other opportunities that you can do with that. You know, eventually when you sell the business and you're looking at this big bucket of money, you know, my biggest job for my clients is to keep that bucket of money sustainable. So you can draw off of that gently to replace that income that you just gave up. You know, we're talking about that psychologist aspect. One of the hardest things that my folks have to deal with is going from being an accumulator of wealth to relying on what they've accumulated. It is extremely psychologically challenging, because right now if the market sucks, great, you just keep working, right? Just keep making more money. But then when you have to rely on that, one of the other certainties I've learned in doing this is the people that have enough are terrified they don't. And the people that don't have enough probably think they do. But my mom is the perfect example, and bless her, I would tell her so right here, she lives every day terrified she's gonna run out of money. And without going into details, her and dad planned exceptionally well for themselves. That will never be a concern. But trying to quantify that with some of those goals and objectives. So I talk about that sustainability of money. If we've got $1 million, 4 to 6% is the general rule of thumb. You know, you can take out 4 to 6% every year, and as long as the market does anything with time, it'll be okay. So $40,000 to $60,000 per year, $4,000 or $5,000 a month before tax, and that's where the question will line up: is that enough? Because when I retire my folks, I don't want to have them sit on the couch eating Cheetos and watching Price is Right because they don't have enough money to do anything else. I want to continue that lifestyle, whatever that is. And the other small spoiler alert: your first few years, however much money you spend now, you're going to spend more because spare time is expensive. So plan for that. So cast that vision, take a step back. You have to make time. So one of the beauties of COVID for my wife and I is we got really good at the backyard date night. You know, go on the back deck, turn on the fire pit, turn on some 90s country, get on a glass of wine, glass of beer, whatever, and just talk. And that's where the vision starts, right? Don't attach dollars to it. Don't attach specifics. Just be like, hey, if we do this thing right, what does it look like? And then find a counselor that can counsel you as well as you run your business, that they can help you cast and support that vision on the other side. The other thing, and we're a little short on time, I apologize. As small business owners, as professionals, be prepared for the identity shift. You know, again, I'm blessed with a lot of perspectives and the ability to wear a few different hats in my lifetime. I just hung one up about this time last year. I was a volunteer firefighter for about 20 years, and I love my job. I love my job. But if I'm being really honest, I love fire a little bit more. You know, being able to help people, do all those things was one of the biggest blessings of my life. But retiring from it at 44, you know, my boys, I'm leaving here after this to go get my son his driver's license. Time is flying. So I was doing something for free, so I finally decided to hang it up. But it gave me a tremendous amount of appreciation for having to let something go that you love deeply and you care about. So as you're casting that vision, the next thing is to have the decompression plan because you're proud of what you built. It is you. Again, you don't want to leave your employees or your family hanging. So identifying a little bit of what that transition is and having steps in place to help decompress is a critical step as you consider some of these things. So I appreciate the time. With that, we're going to have Kelsey come back up. She's going to lead a quick question and answer session for us.
Guess what?
So quick, we're not even going to do it. I am super important. Thank you, Tom and Brad, the team at Equity Advantage. This was super cool. Please stick around. There lots of food. We might be out of coffee. Sorry about that. And talk, ask questions. Tom, Brad's in the back there. And then we've got our tax team here. One of the things so that I can make sure I'm providing a good time for you guys, would you please fill this out? It's only like 5 questions. So they'll be up here. And then, people that are from Salem, do you guys know about the Brothers Car Museum? Or you've toured it? No? Okay. Randomly, it's the largest private car collection in the United States, and it's in Salem. We have been very fortunate to have a relationship with the brothers there. They let us come and hold an event, sell tickets, and give it to a nonprofit. So that is what we are doing this year. It's in August. All of the money will go to Isaac's. They have a downtown coffee place here that you probably are all familiar with, but they helped underprivileged youth. If your parents were incarcerated, if you're in the foster care system, if you don't have a support, they will provide you a mentor, a job, financial literary skills, and a bunch of stuff. So we're trying to raise over $100,000 for them. So I've got info on that too. Please join us. It's in August. Okay. Any questions or anything you'd like to say before we disperse? We can talk amongst ourselves. Okay. Thank you everyone for coming today.